Hey everybody, Jay Alexander here with North Star. Hope everybody's doing well on this Monday. Wanted to get this video out to you guys last week actually and had a few technical difficulties, but looks like we have that under control now. So want to break down some actual numbers and maybe a few pieces of the puzzle that I think are getting missed when we're discussing a 50-year loan. So I created a quick spreadsheet. Let me jump into it real quickly. So I ran these numbers based off a $300,000 loan amount, and just on the surface wanted to show that at a 6.5% rate for a 30-year loan or a 50-year loan, you can see here the principal and interest on a 30 years about 1,900, principal and interest on a 50 years about 1,700. So the difference between the two loans is a little over $200 a month, and that's not bad, right? I mean, that's monthly savings. Maybe that helps someone potentially go buy a house, or maybe someone who can't find a house at a $300,000 sales price, but can find something that'll fit their needs at $315 or $330. Maybe that bridges the gap and gets them into a home. So, there is the potential for some monthly savings here. But certainly there's a concern with paying the loan down, right? So let's look at that. And what I did is I just carried out the numbers if we go out 5 years, okay? So you can see here in 5 years, if we make the minimum payment on these mortgages, on a 30-year loan, the $300,000 loan amount is going to go to about $281, where a 50-year loan after 5 years is going to go from $300,000 to a little bit over $295. So we haven't even paid down $5,000 worth of principal in the first 5 years. I get that number is, psychologically kind of hard to swallow. Definitely there's valid concerns there. Someone's lived in a home, made payments for 5 years, and really have almost paid off nothing in the way of amortization or paying down the loan. So definitely understand the concern with that. But the piece of the equation that I think kind of gets missed is if we carry out a few more calculations. And what I'm doing right here, guys, is I'm assuming that a home will appreciate at 3% per year. That's pretty reasonable for real estate. Some people might be more aggressive and say it'd be higher, but we can change these numbers. So we'll look at that here in a second. And the key is whether you finance a home for 30 years or 50 years. And honestly, guys, this is why adjustable rate mortgages work. It's why initially when we came out with it, subprime loans back in 2004, 2005, 2006, they all worked. If homes are going up in value and homes are appreciating, it doesn't really matter how you finance the home. You can see here at 3% appreciation, a $300,000 home, and just to make the math easy, I assume that we bought a home for $300,000. 3% appreciation for 5 years means that home's going to be worth about $347. And here's the key, that home's going to be worth $347, $350, no matter how it's financed, right? Now, yes, the equity position will change a little bit due to the fact that we've paid the loan down some. But I don't know about you, but whether 5 years from now I have an extra $67,000 worth of equity or only have $52,000 worth of equity, either one of those numbers sound pretty good to me. Obviously, if home prices continue to rise at a faster clip, say we have 5% appreciation, now you're looking at having over $100,000 versus almost $90,000 in equity. But even if homes just really value slow down and they only appreciate at 1%, well, that's still not bad, right? You're talking about $35,000 worth of equity versus $20,000 worth of equity. If someone wants to write me a check for $20,000 and says I can't cash it for another 5 years, I would still probably take that check. So the take-home message here is that if you think real estate is a good investment, and I certainly do, having extra options to finance that real estate, can bridge the gap and can make homes potentially more affordable for an ever-increasing or, marginally, but a little bit more of the population. Now, with that said, there's some built-in assumptions in this sheet that I want to discuss that I think really matter. The first thing is this assumption right here It's not realistic to think that a 30-year loan is going to have the same interest rate as a 50-year loan, just like a 15-year loan doesn't have the same rate as a 30-year loan. On average, the spread's about 80 basis points between a 15 and a 30-year, but just to be conservative, let's say that the 50-year loan only is 50 basis points or a half a point higher. That's a 7% rate on a 50-year loan. And now that erodes the savings significantly. Now we're only saving $90 a month. Or in today's world, one dinner out to eat per month is really all the savings that you get going from a 30-year to a 50-year. Is that really worth it? Is it really worth the headache of trying to figure out how to do this and pool it and create demand for it in the secondary market? I'm not really sure. But the other huge assumption built in this entire spreadsheet that I think really is what matters at the end of the day is that individuals will only see these values and only see this appreciation and only see these loan balances go down if they're able to work a good job and have the economy work for them so where they can make the mortgage payment for the next 3 years, 5 years, 7 years, 10 years, or what it is. In my personal opinion, our elected officials should be working more on things like that and making sure we have an economy that's welcoming to the working class, more so than trying to come up with a special program or a special product that might be helpful to real estate. Again, not saying it won't be helpful, but I don't know for the time and effort it would take for the amount of savings that we get is really worth it. And then for one other data point here that I want to show you, let's go back to a 6.5% loan on a 30-year mortgage. Really, to see this same amount of savings, to see a $200 a month savings, all you need on a $300,000 loan is for the 30-year fixed rate to go down a little bit. If rates go down to 5.5%, now you're looking at the 30-year payment is almost exactly the same as what a 6.5% 50-year payment would be. The government can do things to help drive mortgage rates and drive overall interest down. And the key to that is to spend less money and not run these huge deficits. I think if we hold our elected officials accountable for, working on the economy, working on spending, working on budgets and things that I think really, really matter in the day-to-day operation of what they should be doing, the need or lack of need for a 50-year mortgage will fix itself. So anyway, that's my opinion on it. Let me know what you guys think. If you have any questions about this, if you want a copy of this spreadsheet, let me know. Happy to send it out. Hope everybody has a wonderful Monday, a great week. And if you have any questions, just give me a shout anytime.